Let's talk about the US stock market. Despite ongoing tariff uncertainty and surging US federal deficits, which have sparked renewed fears, the US stock market hasn't shown much weakness. In fact, it continues to climb strongly. Just this Tuesday, all three major US indexes closed higher. The Dow rose 0.51%, the S&P 500 gained 0.58%, the Nasdaq was at 0.81%. On Tuesday, all three indexes were very strong. They performed impressively. But one thing to note is this: the S&P 500 over the past month has surged 6.3%. That's its best May since 1990. It's now very close to its all-time high. You can see this clearly on the current chart. It's just a step away from the previous high at 6,147. The gap is really small now. This brings a different reaction to the market. Because it's so close to the old high, if it breaks through at this moment, the S&P 500 could trigger a major rally. That would really boost the market. It would lift the market confidence. This would be a strong catalyst because it's a new record high, so this is worth highlighting. Let's pay close attention to the S&P 500's moves. If it stays strong going forward, the market will get a big boost from its positive momentum. According to Bank of America, this rally has mainly benefited from the strong performance of tech giants. After 7 weeks of worries, the S&P 500 has now turned positive for the year, especially since the low in early April. From that point, it has rebounded by about 19.8%, nearly 20%. So as the S&P 500 nears a key level, market attention is extremely high. Even with this bullish sentiment, especially in today's environment, there are still concerns. Tariff uncertainty, surging budget deficits, and importantly, economists are worried about possible weakness in the labor market. If the labor market slows, it affects employment. No jobs means no income. No income means lower spending. And consumer spending is the key driver of US growth, so this has major implications ahead. In such a complicated situation, it actually creates headwinds for the US economy. But despite this, the US stock market remains strong. It's held up well. So what does this show? When sentiment is bullish, even negative news can be interpreted as positive. These risks get overlooked, giving the market even stronger bullish signals, especially with the S&P 500 near its high. If it breaks through, that would be a major catalyst. It would be extremely bullish for the market, especially lately we've also seen strong trading volume. There's a clear volume increase here. After the spike, the market kept rising, it kept climbing, and then it showed clear signs of breaking out above the recent range. Right here, it formed a small trading range. This range was briefly broken on Tuesday. It was a slight breakout, but not a decisive one yet. If it does break out clearly, it will be close to the previous high, but it's clear that breakout is likely coming. Now looking at the MACD indicator here, you can clearly see the fast and slow lines are crossing. This forms a bearish crossover. After that, bearish momentum is just starting to appear. At this point, we can see the bears are pushing back. Short selling momentum is picking up, but this move isn't very strong. There's no clear surge. Instead, at this stage, the index chooses to move higher. It's now very close to a strong resistance area, but it hasn't shown any weakness. This is a high volume zone and a previous high, so this is a major resistance area. But the index isn't showing any sign of retreat here. In fact, it's showing signs of a breakout, so the S&P 500 has looked very strong lately. That's why at this key level, the market is paying close attention. If it breaks through the previous high, setting a new record, that would be huge news. It will draw a lot of attention, it will attract more capital. At that moment, investors would likely join the rally. That's a very positive signal. Let's wait and see what happens. If the S&P 500 breaks out successfully, which sectors will benefit the most? It will definitely be technology, especially the Magnificent 7 tech stocks. Take Tesla, for example. Let's look at Tesla's performance. Let's talk about it. Let's move from the index to individual stocks. Tesla's situation. For Tesla, it's also reached a key turning point recently. Why is that? because CEO Elon Musk has made a firm commitment to focus full time on Tesla's operations. With this change, Tesla's operational focus and execution stability are expected to be significantly impacted. Strategically, Musk's main focus will likely be advancing autonomous driving technology, especially the upcoming self-driving taxi service in Austin, Texas. This new service is about to launch. What does this mean? It means Tesla's strategy is shifting from affordable EVs to high-end autonomous driving. If robotaxi operations succeed commercially, it could significantly change Tesla's market positioning and revenue structure. Right now, Tesla is facing operational challenges. It's been hit hard recently. Looking at Tesla's Q1 2025 results, their financial report clearly shows the difficulties they are facing. Tesla is in a tough spot. Vehicle deliveries in Q1 fell year over year by 13%. Operating profit plunged 66%. These numbers reflect the operational and market pressure facing Tesla. At this point, what's urgently needed is decisive leadership from management and strategic adjustments. So for Tesla, Musk's decision at this time to focus full-time on Tesla's operations can help boost market confidence, especially as Tesla shifts to autonomous driving and AI development. For Tesla, this could improve market expectations for the stock. But Tesla's recent performance has raised concerns in the market. There's clear worry. You can see this clearly in the stock price, especially lately, even as some tech stocks have rallied. Tesla hasn't performed well. Tesla hasn't stood out at all. On the chart, after breaking a small range, it quickly fell back. It rallied, then pulled back again. It kept falling back. Looking at this area, it's clear the market is still worried about Tesla's outlook. Concerns remain for the future. Looking at the MACD indicator, there's a clear bearish crossover, a dead cross. Bearish crossover formed, bearish momentum is slowly increasing, it's growing, but volume hasn't expanded much. Given this situation, the market here is not showing much enthusiasm. There is little active participation, so people remain cautious. They're still worried about Tesla's future. The financials are not very encouraging. The numbers are not great. Even with Musk's return, the company's future strategy will focus on autonomous driving, smart driving. This should provide clear direction for Tesla's future and improve its market outlook. It should also bring better expectations for the stock. But right now, the stock price still isn't strong. It's not showing strength, and in the short term, especially on the 30-minute chart. So we still need to watch how the market develops, especially after Musk fully returns to management. Once he takes full control, we will see how Tesla's situation changes. If Tesla sales start to recover and show improvement, then it will be reflected in the stock price. Even if the market hopes Musk's return boosts confidence, if sales don't pick up in the next quarter and deliveries stay weak, the market will remain doubtful, sales could keep falling. If doubts grow, negative impact will show up, and the stock will feel more pressure. When that happens, it will show up in the price. At this point, Tesla's outlook remains uncertain. It's best not to get involved now. Wait for a clear positive signal, a real improvement. When there's a true recovery, then consider participating. What is a clear signal? As mentioned before, after Musk's return, if sales pick up and the next quarter shows clear improvement, that's a positive sign. If there's no improvement, the market may respond negatively. The stock could break below this support level. Looking at the shorter time frame, like the 30-minute chart, this situation must be avoided. Even though we say at the support level we're not bearish or shorting, it's better to stay on the sidelines. Tesla's situation is unique. If Tesla breaks below this level, around 335.8, and holds below it, a head and shoulders top will form. A head and shoulders pattern. Once this pattern forms, it's a clear reversal signal. In the short term, the stock will likely keep falling, so we need to closely watch Tesla's next moves. Keep an eye on the future developments and the upcoming earnings. Watch the overall price, see if there's clear improvement. That's what we should focus on. This is a key point to watch. Musk's return to Tesla can only boost the sentiment in the short term. It gives the market some confidence, but the real results will show up in the financial reports. So next quarter becomes a key focus. Analysts will watch it closely. Right now, the key is to watch the price. It must not break this level because this is the neckline of the inverse head and shoulders around 335.8. It can't break below. Also, notice the MACD indicator shows clearly on multiple time frames. The daily MACD has formed a bearish crossover. The 30-minute MACD is also turning bearish. It's showing a bearish crossover too. If this happens, it means both time frames align. If they align like this, the downside pressure will be strong. At this stage, it's best to stay on the sidelines. Don't get involved. Stay out. Wait for a clear signal before acting. Tesla's current situation is quite uncertain. The outlook is unclear, so we need to wait for a clear positive signal. In the next quarter, Tesla's results will come out. The earnings report and the delivery numbers will be released. The market will watch closely. There's a lot of attention. These numbers will quickly show up in the market. For now, Tesla's stock price is still weak. It's weak and choppy. So at this point, the best strategy is to stay out, wait for a clear signal. That's the situation now. This sums up Tesla's current performance. There's a clear resistance above. On the weekly chart, the overhead resistance is obvious. This area is a strong resistance zone. It's a major supply area, a high volume area, so the support level must not be broken. If it breaks, the downside will open up. From a technical perspective, Tesla's current trend doesn't look very strong. It's not looking good. At this level, there's no sign of bullish continuation, no continuation pattern, no bullish setup here, no clear uptrend continuation. Instead, technically, the setup looks weak. The MACD has already turned bearish. Bearish sentiment is rising. Here, the weakness is clear, so let's focus on one thing. It's critical not to break this level. As mentioned earlier, around 335.8, that support must hold. If it breaks, there's room for more downside correction. That wraps up today's brief market analysis. If you have any questions or want to share your thoughts, feel free to comment below. Let's discuss together.